Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're just going to do another velocity banking review. So, what is velocity banking? All it is a strategy to pay off debt where you throw all your money at debt with the help of a line of credit. And first thing we need to do for velocity banking is we need a budget. So, we have our income, expenses, and whatever left over is usually in our savings because we're told that as we have debt, it's good to have a savings or emergency fund, and our emergency fund is our savings. And here in our expense breakdown, we're going to list every single debt that we have. So credit cards, auto loan, student loan, mortgage, and food, gas, insurance, and all that good stuff. So you'll notice that this is a different color because every single debt that we have here is in black or black font. And then our whole goal is to make all of our debt go to zero. And then all of our other non-debt items that we have to pay for, food, gas, insurance, all that, is will never go to zero, right? We always have to pay for it. So this is what we're gonna do. Same income, same expenses when we do velocity banking. Okay. And let me go here. And then we're going to put our big boy pants on, which is have absolutely no savings, right? Absolutely no savings. And then we're going to have an idea or concept called cash flow. And the whole idea is once we move some of our debt to a line of credit, we're going to put all of our paycheck, our entire $6,600 into the line of credit, and then take our expenses out and rinse and repeat over and over again. Okay. So let's go ahead and move these three credit cards, which I believe is 75,000. So 35, 25, 15. And I'm going to go in here, add them all up. Yep, that is 75,000. And we're going to move it into a line of credit. So let's imagine that we had a free and clear line of credit available to us, um, which is not going to happen because banks don't lend money to people who need it. But for the purposes of this demonstration, we'll just imagine that we did have it. So let's put 75 grand here. And by the way, if you don't know what a line of credit is, all it is a financial tool where you could borrow money, pay it back, and then use it over and over again. So I'll show you my line of credit, 280,000 right here. I could literally go into a bank's website and with the snap, right? With the snap, I can dump $280,000 into my checking account at a 7.5% interest rate. But I'm not gonna dump the whole thing. We don't need the whole thing. Well, at least maybe here we might need the whole thing if it's 76,000 and we have $75,000 in credit card debt. And so what's gonna happen when we move that debt into a line of credit? Well, these three debts disappear. So this is 000, and or the payments disappear. And so we're literally going from $135 to $2,581.20. And so now your entire paycheck, this entire 6,600 goes into the line of credit, and then you take your expenses out and then you rinse and repeat over and over again. And so after every single month, the balance of the line of credit will go down about 2,000 plus some interest. And so let's go ahead and do the math. Okay. Next month's balance is the previous month's balance plus the previous month's interest minus our cash flow, 2581.2. And then, whoopsie. Oh, how did I screw up here? Oh, equals, it should be minus. Okay. And then we take the average daily balance. So we're going to just do that average daily balance, multiply it by the interest rate times 0.08 divided by 12. All right. And then I'm going to go ahead and copy and paste. And then we see that after every single month, the balance goes down. And you see these little goats here. Every time you do this, every month that goes by, you get a goat, right? And why are you a goat? This because we're the greatest of all time when it comes to debt payoff. And if you don't know anything about me, first time on the channel, I paid off my mortgage in 2 years and 9 months. So I say it so nonchalantly because I'm kind of sick of it. And you kind of want to have that problem where it's like, oh yeah, it just happened, and you realize like you have rich people problems. Where it's like this is just too boring. Paid off mortgage in 2 years and 9 months. Yeah, yeah, yeah. Blah blah blah. Right. So let's go ahead and do this. I'm gonna copy and paste, and we're just gonna keep doing that. And let's do this, and we see paycheck in, expenses out, paycheck in, expenses out. And then I'm going to copy and paste. And then now we see in 33 months, all that credit card debt is paid off. So isn't that fantastic? We are the GOAT, 33 goats. Greatest of all time for paying off the debt so quickly, and that's 75K. And then we're gonna just do this a couple more times. And now we have 3 more loans. We got the auto loan, student loan, the mortgage. I've done this a billion times, so I know we're gonna take out the auto loan first, but let me show you reference this loan calculator right here. And all I gotta do is put the current month of the loan. So 33, 33, 33. And then so now we have the current balance and ignore this part for now. And so now what are we going to do? Well, we're basically gonna move this loan into the line of credit and then get back the $449 of cash flow. Now, why do we attack this one instead of this one? Because this one has a higher interest rate and this is a student loan, right? So, why do we attack that one? Well, it's because if we attack this one right here, 27 grand, we only get $388 in our cash flow, even though it's a 6% interest rate. It's actually the highest interest rate out of all of them. Whereas if I tack this one right here, 11 grand, I get $449 back in my cash flow. So you get more bang for your buck just in terms of cash flow. So let's go ahead and do that. Copy and whoopsie, I'm the wrong one. Copy and paste, right? We're going to copy and paste. Okay. So copy and paste. So this one is plus 11714.43. Okay, and then guess what happens here? Well, this now goes to 0, right? And then our cash flow is 3 grand. Isn't that amazing? So we literally went from $135 in the struggle bus to $3,000 a month in less than 3 years. Okay. So let's go ahead and do this and update our cash flow numbers. Okay. And then so now our new cash flow is 3030.42. I'm going to copy and paste this. And we see that our auto loan was paid off in 1, 2, 3, 4 months, right? And so now in 37 months, we paid off all the credit cards and the auto loans. So 37 months. And then this is 75 plus 25. And then now it's 100K paid off in 37 months. And then now we got to tackle these two, the student loan and the mortgage. So I'm going to show you right here in 37 months where we are. So this is now 0. This is 37, 37. All right. So now the balance of loans is about 226 grand. And again, we're going to focus on paying this one off first. Well, it has a higher interest rate, but it also gives you higher cash flow for paying it off because again, I have to pay only 26 grand to get the 388 back in my life. Whereas when I get the $1,000, I got to pay $209,000 to get the $1,000, or I'm sorry, $209,000 paid off to get the $1,000 of cash flow in my life. And usually, if there's an interest rate difference, and again, we're dealing with 6 and 8, so it's not too big of a difference. Moving the entire loan into a line of credit is not a good idea, like in general, unless you have like a significant amount of cash flow that the loan gives you for paying it off, like where we're at the car loan, right? So the easiest and safest method of paying off a loan if you don't want to make direct extra payments and segregate your income is using by what we call the chunking method, which is just moving a piece of the loan into a line of credit, right? So for example, let's say I decide that I'm going to move like $7,000 into a line of credit and then dump all my paycheck in and just rinse and repeat that a couple of times. And so I could just quickly demonstrate that here. So let me just kind of go in here and then I'll just put a $7,000. Again, our cash flow always stays the same until we pay off the loan, right? So 7,000 here, and then you see that the 7,000 pays off in 2 months, and then you kind of rinse and repeat, right? So yeah, another 2 months. So we can just do that, and luckily we have this velocity banking calculator here provided by Renatus, right? So if you don't know what Renatus is, it's an educational platform where I learn pretty much all this stuff, including real estate investing and financial literacy. So if you want to learn it, click the Google form link below. And I get money off of you purchasing me because this is this whole YouTube channel is a poorly designed sales and marketing funnel. All right, so let me just kind of go in here. I'm just going to put in the details here. And if you want the calculator, just purchase it and then you get the calculator with your purchase. What's the original balance? Oh yeah, we're paying off the student loan. So the original balance is 35 grand. So I just got to do is put 35 grand. The current balance is 26343.34. 26343.34. The interest rate is 6%, 6%, 10 years, and then the payment amount is 388.57. 388.57. And then what's our income? We just put it right here. So I'm just going to go here to our budget is 6,600. 6,600, right? And what's our expenses? It's everything except for the loan we're trying to pay off. So it'd be these two. And then I'm going to go ahead and do this. So it's 3181.01. So 3181.01. And then we'll just do chunk a small amount, which is $7,000, arbitrary number. And we see that it pays off in 0.7 years. So $567 of interest. And I'm just going to do this. And this is going to be 37 plus zero 0.7 times 12, which is, we'll say 46 months. Okay. So 46 months, our debt is completely paid off, right? 46 months. And then how much is it? It's 135K. All right. And then now, all right, I'm going to take all of this out and now we're going to attack the mortgage. So at 46 months, we got to find out what the mortgage balance is. Okay, this is 0. And then now it's the same thing over and over again. And here's the thing, a lot of people freak out because it's like, oh my goodness, the interest rate difference is so much. But I'm going to show you. Did I screw this up? Hold on. Oh yeah. I'm going to show you what happens in the worst case scenario, meaning let's say we literally got a 0% mortgage. So after 0%, after 360 months, let me just show you right here. If you get a 5% mortgage, 360 months, we pay 205 grand in interest, right? I don't know if you knew that or not. But you borrow 220, you pay about 205 in interest, okay? Now let's go back and let's say we got a 0% interest mortgage, literally 0%. Okay. Meaning after 30 years, you pay 0 in interest. All right. Which is a good deal. Right. But let's say, like, and I got to put 0% here. This is the worst case scenario that could happen if you decided that you're going to pay a 30-year 0% mortgage with this line of credit. And I'm going to show you what happens right here. So 0%. And I'll just do this right here. And I think. Okay. So 30 years, 0%. This will be 611.11, 611.11. And what's the current balance? It is, we'll say 220, 220,000, 220,000. So we're starting off a brand new mortgage. What's the worst thing that could happen? Oh, I overpay by 1,500, right? So 0 to 8%. Yes, you are gonna overpay because obviously you're using a tool that has some interest to pay something that absolutely accrues no interest. So when someone says that a loan is always better than a line of credit, that's kind of misleading, right? We have to think about the pros and the cons. Biggest pros are not we're gonna segregate our income, but if the interest rate difference is there, right? We may have to pay with more than if we just kind of made direct payments to the loan, right? So 0% interest is the worst case scenario that could literally happen. And oh, I paid off in 4 years and I pay 1,500 interest. Now, when you deal with like higher interest rates, and I'm just going to do the 5%, right? So 5%, look what happens here, 205 grand in interest and we pay 1 grand, right? So it's kind of weird how that works, okay? So let me go ahead and put in the payment amount, which is 1181.01, 1181.01. And then the current balance is 206,627.45. 206,627.45. And then we see that we paid off in 4.2 years. Whoop-de-doo. Okay. For 4.2 years, not bad. And let me go ahead and do this right here. So it's 46 months. Divide by 12 plus 4.2. And that is 8 years, 8.03 years. We are debt free. Okay. Now, just because you're debt free doesn't mean, you do something stupid, right? Because I'll tell you what, I probably need to do a reaction. But today I was watching all these videos in Atlanta because it snows one day. And I don't know if you know this or not, but if you drive in Atlanta, okay, if you drive in Atlanta and it snows one day, the state has to shut down, and people still drove today. It was crazy. So just because you're debt free, you still got to be a little bit careful. I think they call that concept a moral hazard. Like you have, a safety net, and then you decide like you're gonna do reckless things. In life or in the insurance industry, yeah, they call it a moral hazard. It's like, well, just the fact that you have insurance kind of makes you a little bit more reckless than if you didn't have the insurance, I think. But yeah, we're gonna be 8.8303 years debt free. And look at all these goats because we're the greatest of all time. The greatest of all time. Can you believe it? I can't believe it. So this is Velocity Banking again, Korean Atlanta mentorship. I don't even know what else to say, but I can do this all day, quoting my good imaginary friend Steve Rogers. All right, well, have a great day, everybody. Korean Atlanta mentorship, and I'll see you next video.